The Federal Reserve's policy decisions in recent years have exacerbated economic inequality in America, and some of the central bank's policymakers say it's not a problem they can easily fix. Millions of Americans, especially the richest, took advantage of the ultra-low interest rates during the pandemic, when the Fed loosened up monetary policy to shore up the economy. Borrowing costs are now well above pandemic-era levels, but about 20% of homeowners still have a mortgage rate below 3%. Not only do those households have lower mortgage payments, but they've also been accumulating wealth by simply owning a home. Meanwhile, the U.S. stock market is closing in on yet another year of solid gains, boosted by continued investments in AI, marking a stunning 3-year bull market. Low-income households, who are less likely to invest in stocks and are more likely to be renters, have missed out on those so-called wealth effects in the past 5 years. The growth of their wages also trailed those of the wealthiest throughout 2025. Affordability has emerged as a key concern for many Americans, especially for those with lower incomes. It's also suddenly become a top priority for politicians, including President Donald Trump. Fed officials have admitted they can't easily address what economists refer to as the K-shaped economy. When I've talked to retailers and CEOs who cater to the top third of the income distribution, everything's great. It's the lower half of the income distribution that is staring at this going, "What happened?" Fed Governor Christopher Waller said on December 16. Other Fed policymakers, including Chair Jerome Powell, have acknowledged America's widening economic inequality this year. The best thing we can do is try to get the labor market back on its feet, get the economy kind of growing better, and hopefully the job security and wage gains start catching up, Waller said. While monetary policy has played a role in the diverging fortunes between the wealthiest and poorest Americans, it's an unintended consequence. In 2020, the Fed was justified in slashing interest rates to near zero to support an economy battered by the pandemic. The Fed kept rates at ultra-low levels until March 2022, when it began to hike rates aggressively to combat inflation. But the Fed may have played a role in the K-shaped economy much earlier, starting in 2008 with massive liquidity injections in response to the global financial crisis, which raised stock market values and housing values. Since then, we've seen this persistent gap between the haves and the have-nots, which actually narrowed after the pandemic. The wages of the poorest Americans grew rapidly from 2020 through 2023, far outpacing the growth of the wealthiest workers. But that was no longer the case this year. Those at the bottom don't have housing values to help them. They don't have the stock portfolios to help them. And it's harder for them to tap into potential lines of credit, one economist noted. They mostly depend on their wages to outpace inflation. The Fed's main tool, its key interest rates, is widely known as a blunt instrument. That means it can't help specific groups. The Fed also doesn't control long-term interest rates. Over the past 2 years, the Fed has lowered its benchmark lending rate in an effort to keep the labor market afloat. The hope is that those rate cuts will function as a rising tide that lifts all boats. The Fed's best strategy to undo the K-shaped economy may be to simply prevent the labor market from deteriorating, and hope other forces boost employment and wage growth. Turning to the stock market, the S&P 500 is up 18% year-to-date despite economic uncertainty related to the sweeping tariffs imposed by President Donald Trump. After decades when the nation's average tariff rate was below 3%, he has hiked the average tax on U.S. imports to 17%. After Trump announced his most severe tariffs in April, the S&P 500 dropped by 19%, and many economists forecast a recession. But the economy has continued to grow at a robust pace. likely because high spending on artificial intelligence infrastructure has so far offset the negative impacts of tariffs. However, Federal Reserve Chairman Jerome Powell and other policymakers are warning that stocks have become unusually expensive. In fact, the S&P 500 currently trades at one of its most expensive valuations in history by a key metric, the cyclically adjusted price-to-earnings ratio, or CAPE ratio, which stands at 39.4 in December. This level was last seen during the dot-com bubble. History shows that when the CAPE ratio has exceeded 39, the S&P 500 has usually declined in the following 1 to 2 years, with average returns of -4% over 1 year and -20% over 2 years. While some investors worry that the artificial intelligence sector is in a bubble, gains in AI stocks have often been driven by strong earnings growth rather than pure speculation. Still, the patterns of past cycles suggest a decline is ahead in 2026. Investors should prepare for a more challenging year and ensure their portfolios include only high-conviction stocks they would feel comfortable holding through a downturn.